what does 100% financing mean? It
Free
means
houses.
free houses.
For everybody. You get a house. You get a house. You get a house.
What is up, YouTube? And let's cut right to it. I know why you clicked on this video. It's to learn about 100% financing. So before we jump into today's video, I just want to let you know it's 100% possible. And today, Josh and Ehren from the Findlay Mortgage Groups, they're going to break down for us exactly how you can actually finance 100% of the purchase price of a property here in Canada in 2020. What is up, YouTube? Matt McKeever here, and I'm really excited for today's video with Josh and Ehren because we're going to be talking about something that every real estate investor hears about, but it's kind of like Bigfoot, the Loch Ness Monster, 100% financing. One of those things is real, right? And it's not Bigfoot or the Loch Ness?
It does exist. It really does. So one of the big questions we have with a lot of investors who are trying to get their start is 100% financing. And we've been running into a handful of different situations where they want 100% financing, but I don't think anyone really understands what it takes, how to structure it, or the cost associated with it. So we wanted to break down all those things and to have you really understand exactly what you're going to be getting into when having 100% financed properties.
Yeah, guys, so let's take a look. What does 100% financing mean? It
Free
means
houses.
free houses.
For everybody. You get a house. You get a house. You get a house.
Yeah, so what we're going to do is you're going to get a structured loan, whether it's in one or two loans, so a first or a second position. It's going to cover the entire purchase of that property. So that means you're going to be, the down payment is going to be included through probably either the first or for the second. You're going to be writing one check to the seller. It's all coming out of your financing, 100% loan to value financing. It is possible. There's a few things that we're going to go over on how you can obtain that and what type of lenders and what the fees are going to be in there. So just a quick example, to break it down even more simpler, you have $1 million purchase. You're going to cut a check for $1 million. There won't be any other check coming from you personally that's coming out of your pocket for the down payment. That down payment is going to be structured either in the first or as a second position private loan. Can you obtain this type of financing with a AAA bank? The answer is no, you cannot. Bill V20 came out a few years back now, and basically they said that a federally regulated financial institution can no longer structure co-lending or secured loans to act as a down payment. So on the AAA side, 100% financing does not exist. You're going to be stuck with either a B or a private.
Yeah, so for a bank, they're going to require that you can show 90 days history in your down payment. So that has all the AML laws that go along with it. So, but that's also one of the reasons why you can't structure a second behind your first. B banks, so can you do it with a B bank? Yes and no. If you watched our last video, we explained a little bit in detail about maybe some of the ways you could get around it. You can do that by either amortizing out a second to 90% and then adding a home equity line of credit to make up the difference from the 90 to 100% financing. There are only a handful of lenders who can do this, and you need to be sure that it's within your ratios to be able to do something like that.
The other way that we can structure it on the B side or the alternate side is on an undervalued property. So one of those being we can structure a 80% first based off of the purchase price. And then if the appraised value of the property is high enough, we're actually able to structure a second that goes to 85% based off of that loan to value, the appraised value. So like I said, if the property on the purchase price is undervalued enough from where the appraisal comes in, that second mortgage at 85% off of the appraised price might just be high enough to cover the rest of your down payment or get you pretty close to where you would need to be. We just did an example where we had someone at to 97%. So it may not be 100, but 97 is pretty much a unicorn anyway.
Yes, it is.
It's pretty tough.
And the last is private loans. Can you do with a private loan? Yes, you can. You can have money partners who are going to come in and give you the difference from what your first is going to give you. You can have equity in another property that you can leverage to be able to purchase a home with. You can have saved funds. You can have many other sources of income. Most lenders require that the bank do the AML. So There isn't really, depending on the lender, obviously, there are some institutional private lenders out there who do require 90 days history of funds, but the majority of them do not. That being said, using private lenders is the most prevalent way in which we see people trying to get 100% financing.
Yep. And there's two types of financing out there that we can do on the private side, and that's going to affect the rates a little bit and the ability for those privates to kind of structure some of the creative solutions that we have. The independent private guys out there are what we call like mom and pop type lenders, where they're essentially just financing deals with their own money. The loan to value might be scaled back slightly less on those guys, but and the fees might be a little bit higher as well too. You're probably looking at least 2% in the fees. The interest rate is typically a bit higher on these true private guys as well too, the non-institutional guys. Then there's the mortgage investment companies. Because they have actual investors, they are more subject to some stricter underwriting guidelines on the private side, but they are able to drop their interest rates a little bit and become a little bit more competitive. Turnaround times and, like I said, due to the restrictions, it does kind of cut them out of some deals depending on what the borrowers are looking for. But we do have those options for the deals that we're able to make it work.
One of the interesting things that we're able to do with private equity companies are they have two different funds, or they might have multiple different funds, and each different fund they have certain lending parameters that they're willing to use. So some are going to allow you to go to 85% loan to purchase, and some are able to go to 85% loan to value. Now, if you're buying an under market property and you want 100% financing, usually what they're going to do is they're going to offer you two separate loans, a first and a second. And depending on the fund they have, it's going to be maybe cheaper for the first, but more expensive for the second. But they're able to actually tier it so you're very, very close to the actual purchase price, your loan to purchase, and not your loan to value, which is extremely helpful. So we wanted to go over just something, a deal that we saw a little while ago, and we wanted to run the numbers by you so you guys can actually break down and understand maybe what the costs are. Because if you lock up a undervalued property, but you want 100% financing, it depends on how much equity you have that you're getting, because all the fees associated with that might eat up a large chunk of that equity you have. So your bottom line might not be your bottom line anymore. Your profit might not be the profit you think you're going to make if you don't have any money to put down on a property.
Yeah, so I'll give you guys a quick outline of the deal that we were helping our investor with. So he had a purchase and sale agreement for $1,075,000. Now that was a purchase and sale agreement. The actual appraised value that they brought to us on the appraisal was $1.3 million. So you can see there when we're talking about an undervalued property, that's quite undervalued and a good pickup for the investor. So what we were able to do is we were able to structure them a first loan. The first loan was $973,500. So this brought the loan to purchase, again off the purchase price, to 88%. And that was after the lender deducted their fees from the advance of that loan. So that's important as well too.
So setting expectation for a lender fee, a lender would charge on something like this around $29,205. It's not cheap. But the rate on something like this, because it's one of their premium private lending products, was only 7.25%, which makes the actual payments really affordable. Now the second was structured a little bit differently. They use loan to value. So this specific pool of capital, they're only allowed to lend on loan to value, so they're able to make seconds and structure seconds a little bit higher than they would loan to purchase. So this specific one broke down as $129,800, which was the maximum that fund could go to, 85% loan to value. The lender fee on that was around $7,139. And all these terms were completely open, and the payment was around $1,379. So the carrying cost for the specific investor was actually relatively low, but a bunch of the fees that had to be paid out of the advance were quite steep. So when you're calculating or trying to understand how much out of pocket you're going to be, you still have to come up with some fees out of pocket, but it is a way to get quite a large loan with very little down.
Guys, if we take a look at what the actual advance funds to the client were, came in around $1,062,906. So you compare that number to the actual purchase and sale agreement of $1,075,000. That's as close as you're going to be able to get. And we actually were able to get that deal to about 97% loan to purchase with fees and everything. So like we said, even though it's not 100% financing, this particular investor didn't have any collateral to come to the table to be able to bring a private lender to 100% loan to value, and this is kind of the next best option that we're able to do to help them out with. So,
yep. So something to keep in mind is that from a lender's perspective, there's more risk in lending in a second position mortgage than a first. Mm-hmm. So internally, there's only a handful of capital companies out there who will do this deal because they need to have the funds for the first and the second. Because if somebody like a private lender were to go in the second position, say behind an almost $1 million first mortgage, the immense risk that person will be taking, say the property foreclosed, they would lose their investment. So it's important to work with capital firms or private mortgage investment companies who have the capital to be able to structure these deals properly, because most mom and pop lenders will not loan behind a private first mortgage.
Mm-hmm. Awesome. I love it. Really powerful example. And just to break it down at home for the audience, had this property came in valued at 1.4 or 1.5 million, would he have been able to finance 100%?
For sure.
Yep. Or even more if it potentially even more. I don't want to guarantee that, but we do have the ability on private mortgages to go above 100% financing. And I think we talked about it in a previous video with you guys where we had a deal that we had done. We got it close to about 115% loan to value, I think. So we were able to pay everything out of the advance of the loan. So it worked out pretty well for the investor.
Love it. So if you guys want to try and be able to put together 100% financing on a deal, you need to make sure that you're making your money on the buy. You need to be buying with a lot of built-in equity, because by buying with that built-in equity, it's going to reduce the perceived risk for our lender, right? And that's why our lender will even consider financing it under these terms.
Yeah, it can be decently difficult for most lenders to wrap their head around somebody not putting any skin in the game. So quite a few people will just say, no, we're not interested. But there are a handful of lenders out there who will play ball depending on how much equity is in the property and if they actually believe the value that the property is. Some will request their own appraisal by somebody that they trust if it's an appraisal that they didn't order themselves. But all the T's are crossed and I's are dotted. They make sure that their position in the loan is secure.
All right, let's keep going down the rabbit hole of 100% financing. So what other tricks, what other tips, or what other things are we not aware of when it comes to trying to get that 100% financing?
So the next thing that we want to talk about is vendor takebacks, and I think a lot of the investors actually in your group are aware of this one, but maybe some of you, there have been some people who've reached out and don't really know much about it. They've heard the word, they weren't quite sure what it is. So vendor takeback is essentially the seller type financing where the seller leaves a certain amount of equity in the property for the buyer to use to act as a down payment, and essentially it comes on to the title as a second mortgage. Now, there's some really great benefits for structuring these vendor takebacks, and some of the deals that I've actually seen in the cash flow tribe, I've seen some people who were able to structure 90% loan to value in terms of a vendor takeback with 0% interest. That's a killer deal. You're not going to find that on the broker channel or on a bank channel. That's you guys going out there knocking and putting in the work with your ability to navigate the deal. So obviously reaching out to yourself and Adam and whoever else is dealing with that, and just learning the ways to communicate and structure those deals is super important, because those big deals are getting done out there, and that's only deals that investors are going to be able to find on themselves. So those do happen. But kind of going backwards there, the vendor takeback option does allow us to get to that 100% financing. If you can structure a vendor takeback that's in the amount of what you would need for the down payment, we can put that on the title as a second mortgage. That'll come in to be able to close as a down payment, and you're getting yourself into a 100% financed property. So that's it's a really strong option out there, and the ability to save on that interest rate is paramount, I think, in terms of cash flow and saving yourself some of the monthly payments. So really strong option. Much better than structuring a true private second rate, because on that true private second, there's going to be fees, there's going to be a larger interest rate. The loan to value is going to be a little bit less than what you're going to get, so or could be less. So again, super strong option.
And so when we're looking at, say, getting a second place vendor take-back mortgage, typically if I'm trying to set myself up for success in regards to trying to do 100% financing, what size of mortgage should I be aiming for? Is that 20, 25, 30%? Or is there kind of a standard rule of thumb you guys would use?
Yep. So most lenders, depending on how you're looking to qualify, whether A or B, between 75 and 80% loan to value on a refinance, on a rental refinance. So you're going to want to make sure you either have the appreciation in the property that's gained a little bit over time to the end of the term of your vendor take back, or the vendor take back is 25%. You have a way to pay it off at the time. So something also important to note is the vendor take back that you structure, you need to have a plan to be able to raise the value of that property. So maybe a 1-year term isn't the best option for you. Maybe that 2-year vendor take back, or 3-year vendor take back are open after the 3rd year, something like that, something that's a little more flexible, that's going to allow you to really take in the appreciation of the asset, lift the value up to help you be in a better position to qualify if you don't have a specific exit strategy as to putting renovations in or doing something else to add the value to the property. Because at the end of the day, that equity needs to be there to refinance out. You can have zero money down on the property, but if you're refinancing with a private every single 2 years, every single year you're paying those fees to get back into that mortgage, it eats up the equity decently quickly. So having that strategy to be able to get that done is super important when structuring your vendor take back.
Love it. Great tip.
One of the risks of taking on a vendor take back mortgage obviously is leverage. So you have no equity in the property. You need to be sure that either your cash flow covers all the costs, and that you have a slush fund available to be able to cover any debt that's going to come from the property. Like if you have to do any repairs, if you have to take care of any vacancy. There are a handful of things that are maybe some risks associated with completely leveraging yourself. It is risky. It's something you should definitely talk to your mortgage broker, your lawyer, your accountant about. It's not necessarily for everybody. It's for people who understand how to use it properly, and it's for people who want to use it as a tool to be able to move forward with their investment journey. So before taking the first step to do it, I'd highly recommend taking a look at it, understanding the risks associated with it. I'm not saying it's a bad thing, but being 100% leveraged is definitely something that you should think about strongly before moving into purchasing a property with this type of financing.
And one other extreme type risk that you should be aware of too when you're going with these 100% financing options is, and one of the risks that we always go over when we do our mortgage closing packages, land appreciation can go down sometimes. And we are in a bit of a uncertain economy, so there is always a slightly greater chance at this point too. So if you do get into a property 100% financed, if worst case scenario that property were to lose some value, you're going to have to make up even more equity through some sort of sweat equity or additions or increased rent, whatever your method is. That is still a large risk that's out there and comes with 100% financing. So we just like to have full disclosure with all our investors because it is like Josh said, it is a big thing to take on 100% financing, and you are 100% leveraged. So
yeah, absolutely. So as we move into more sophisticated and complicated real estate strategies, it's really critical that you guys don't just have your plan A, but you've got a plan B, a plan C, and a plan D as well. And for a lot of investors that are maybe getting into that 100% financing on an investment property, their plan B might look like having another property that they know down the road, if they had to, they could get a second mortgage on that to try and make themselves whole on the new investment property. Or maybe immediately lining up other money partners at a higher interest rate, but knowing that you can always fall back onto them in that situation as well. But absolutely critical that you guys have more than a plan A if you're getting into deals with 100% financing.
Yeah, absolutely. Moving forward, the next kind of option that we have for 100% financing is on our B lender secondary type financing. So we had a lender that reached out to us the other day. We've been looking for some more creative financing options for you guys. You asked, we're trying to deliver on that for you guys. So we had a B lender reach out and said that they'll actually consider doing a second mortgage, an amortized second mortgage. So this is going to have to be an institutionalized second. It's not going to be able to be structured as a vendor take back, unfortunately. But still, nonetheless, it's a great option. Have that structured up to 90% as a second, and then they'll allow for a HELOC payment to come in and make up for that extra 10% financing. So when you take a look at the fact that the HELOC is a borrowed type fund, we're still getting you essentially 100% financing. And the best part about this B bank is that first mortgage at 80% loan to value, you're making principal and interest payments. So when we talk about exit strategies and there needs to be some equity in that property, when you're making a principal and interest payment, you are making payments towards the actual principal amount that you borrowed, and that on itself is going to start increasing the amount of equity that you have in the property when it comes time to refinance. So one of the other things that we talked about in our tips and tricks was maybe doing an accelerated payment. If you were to structure that and make a principal payment, by the time you go to refinance, you're going to have a much better position of equity in the property and a much better chance of refinancing out and maybe recouping some of your costs of renovation as well.
Guys, it's important to note that when we talk about exit strategy, moving into a B lender from a private lender, if you're already in a B lender, that is the exit strategy. You're already there. Like you can renew, you can get a longer term. You're already in the principal payment product. I mean, we can get you in an A lender, but most investors are B is where it's going to be. You're going to stick there. So if you can already get in initially, you skip that private step. You skip getting in and then having to qualify for that next step. So this product is really a game changer for a lot of people.
Mm-hmm. And I know we've had a lot of people reach out in the past asking about HELOC payments for down payments and whatnot. And now we have an even better option that you can use the HELOC and use that towards a potential 100% financing. So it's definitely a win-win situation, I think.
This specific lender actually thinks of HELOC or classifies the HELOC as your own funds, whereas most institutional lenders see it as borrowed funds. So it's just a classification as to how the funds are being used and how they look at it. So this is an investor-friendly lender, so they see it as your own funds because it's coming from the equity of your own home. So, I mean, it's just a matter of who you work with and how you can structure the deal.
Yeah, that's really powerful, and that's actually a really exciting technique that I don't think many investors in Canada are even aware exists. Do you want to get control of your financial life? Do you want to crush it in real estate with wholesaling? Do you want to join my full-time team of wholesalers like Mike? Or Shahir? Or what about Tyler? Or Diego? Or what about Amar? All right, and what do we do, boys?
We make offers, we buy fast, never gonna miss a deal cause we pay cash. Offers, 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 deals, deals, deals. Tell us, Mr. Seller, what price do you feel? Cause we're Southwestern's biggest source of deals. Boom!
So if you guys want to crush it with wholesaling, you need to join my team. And down below, video description, there's all the links you need. Yeah, that's really powerful, and that's actually a really exciting technique that I don't think many investors in Canada are even aware exists.
So just to give a quick example of what a deal could look like on 100% financing on the B side, have an example here for you guys. So we have a purchase price of $800,000. Let's say you're able to get a first mortgage structured at $640,000. You'd be able to register on a private second, an amortized payment second mortgage at $80,000. That brings the total loan to value to 90%. If you had a large HELOC against an open property, an $80,000 HELOC payment brings in that additional 10% to act as the rest of the down payment. We're essentially at, or are at in this case, 100% financing on a B side. And just to give you guys an idea, a B side right now, our 1 year term is 3.09. So you're starting to enter, A territory. It wasn't too long ago where some AAA rates were up and around the 3%. So, we're starting to embark on that, and it's a great option to get you in. Especially even more so if you want to take a look at a accelerated payment structure for that first year. You're not only are you increasing the amount of equity you're going to have, but the rate is, it's so low that it's not really going to have a huge hit on your cash flow or your monthly expenses. So could be a great option for a lot of investors out there. Okay, so one of the things we want to just go over is just some of the costs that's going to be associated with that. On the B side, since it is a B mortgage, there is going to be a 1% broker and a 1% lender fee. And then on that second mortgage that's structured, some private lenders, the institutional, will do either 2% or a minimum of $3,500. So you can expect your lender and your broker fee to be somewhere between $1,600 to $3,500. And then, of course, there will be your legal fees as well, too. We estimate around $3,000 to $3,500 on the high side just to be safe. So total fees in, you're looking somewhere between $19,000 to $22,800. So, not a bad cost for getting it onto a B side. Especially when we take a step
back and think about getting financing at 100% on $800,000, that's really powerful.
Mm-hmm. The amount that you're probably going to save on the monthly payments just with that 3.09% first, is a great increase in cash flow for a lot of investors as well too. So
Sure, and it's important to note that also like those fees, like the private mortgage fees, it's a one-time fee. Like I mean, hopefully you're going to get out of it in a year. You're going to have some sort of strategy to raise the value, refinance, pay it out in a year, and then you don't have to deal with that second. Or you can start paying off your home equity line of credit that you use to purchase the property with.
But you're entering into the property with just paying the fees instead of a whole down payment. So it's important for these 100% financing type deals. And one of the things that we really notice is you have to take a look at the entire effective cost of borrowing, right? Even though you might be paying some fees out of your pocket up front, you got to take a look at the effective cost of savings down the line and what you're truly saving. And not just kind of be shocked by a relatively larger number coming out of your pocket. Sit down, do the work, and we'll do it for you. We'll show you the cost of savings, and we'll make sure you understand the deal you're getting, but understand the importance of taking a look over the overall cost of borrowing and the cost of savings when we present two different options.
Yeah, it's absolutely critical as an investor that you focus on the big picture when it comes to these costs and fees. I know my lawyer every now and then has a heart attack when he sees the fees we pay, but he's looking at it as a big lump sum transaction rather than the way we really approach it, which is really amortizing it over the cost per unit. And if I'm walking into a property where I believe I'm buying it for $10,000, $20,000, $30,000 below fair market value per unit, all of a sudden having even a lender's fee that adds up to $2,000 or $4,000 per unit really isn't that hard to swallow. So again, it's really important that as investors, we leave our emotions at the door, focus on the data, not the drama. So this was an amazing breakdown, guys. I think this is one-of-a-kind information. If you guys enjoyed this video, you need to smash the like button. But I know that there's going to be a million questions, and people are going to reach out to you because now they're just salivating, thinking about 100% financing. So what's the best way to get in contact, guys?
Sure, you can reach out on our social media, on our Instagram.
My personal one is just Laycock22. That'll be down there below. You guys reach out. Like, we're happy to give our phone numbers out and have direct communication for everybody. One of the things we're talking about before this is just approachability. We love when you guys reach out. It makes us think, and there's the occasions where we start learning new material because you guys push us to our boundaries. So we welcome the conversation and the questions that you guys have. So feel free to reach out.
Yeah, even if you're not purchasing something right now and you have some questions, we're happy to kind of guide you to where you got to go to make sure that you guys have the information you need to make an informed decision and start that journey.
Awesome. Well, thanks again, guys. We'll throw all their contact information in the video description down below. Really encourage you guys to reach out because I know 10 years ago, back in 2010, when I first started investing, had I known guys like this, I would have been all over strategies like this and all the other things that we've covered on my YouTube channel related to financing with the Findlay team. Thanks again to Josh and Ehren for showing us this very unique investment strategy. I had no idea that this was even possible, so I literally learned something on today's video. I hope you guys enjoyed this video. If you did, smash that like button. Hit the subscribe button if you're new to my channel, and make sure you jump in the comments section and let us know what other aspects when it comes to financing or mortgages do we need to cover on my YouTube channel. Let us know in that comment section down below.